I'm Lisa Birnbach for Howdini.com. Gosh, there's so many ways you can invest your money and so many ways you can mess up. How do you do it? To discuss this, Carolyn Bigda, reporter for Money Magazine. Hi, Carolyn.
Hello.
Well, starting from scratch, you have some money, you have some savings. Where do you start?
When you're putting together your portfolio, a lot of people, the first place that they're going to start is their 401k. It's the easiest option, really, because the contributions are taken directly from your paycheck, and your employer sets up the number of mutual funds that you have to pick from. So that's a great place to start when you are putting together your portfolio.
When you are starting out, do you need to do a lot of homework, or can you really trust your employer to do the homework?
Now, you definitely need to research the mutual funds that you're investing in, unfortunately.
Yeah, too bad.
It's your responsibility, and you want to be picking the assets, or you want to be picking the investments that are going to meet your goals. Stocks will perform differently than bonds, and so you need to know the difference between those two, and you need to find funds that have low fees and an investing style that is going to suit your portfolio.
Do you need to diversify from the get-go? Is that a wise way to go?
Yes, one of the major mistakes that a lot of people have made over the years is they invest a lot of their money in the company stock. And we don't need to think about Enron or WorldCom. We all remember those cases and know what happens or how risky it is to put all of your money into one stock. So you want to diversify. If you do hold some company stock, keep it to 10% or less of your portfolio.
Oh, good to know. And what about real estate, bonds, all other forms, even art? Do you advise that people really think in a much broader way about investments?
Sure, you want to get the basics down first. So you want to have a range of U.S. and international stocks, probably sprinkle in a few bonds, and then once your portfolio starts to grow, then you can branch out into other things like real estate and commodities. And yes, people are even investing in art these days.
One hears that stuff might be a better thing, just stuff might be better than stocks. I mean, the market is very volatile.
Sure, the market is volatile, but if you're a long-term investor, which you should be if you're saving for retirement, over the long term, stocks return an average of about 8% to 10% every year. And that's going to really make your money grow. So ignoring stocks completely is probably not a good idea.
Should you take tips from a friend who seems to have done well in the market?
Probably not. That would be one of the other big mistakes that a lot of people make, and that is chasing performance. Great for your friend if he found a wonderful fund that's doing well, but funds and stocks and every other asset sort of have they have life cycles, and they have ups and they have downs in those cycles. And so you could very well be investing right as that fund or stock is about to come down, and you would be losing a lot of money.
Is there a virtue in playing it safe?
There is a virtue if you need that money right away or soon. But if you invest too conservatively when you're young, or you're saving for a goal many years out, it can actually be it can be a roadblock for you. We looked at one portfolio. Let's say it was a $200,000 portfolio, invested 75% in bonds, which are conservative, and 25% in stocks, and over 25 years, that portfolio actually returned $500,000 less than had you invested more of that money into stocks and less into bonds.
Amazing.
So you don't want to play it too safe.
Great investment advice, Carolyn. Thank you so much. For Howdini.com, I'm Lisa Birnbach.